Ever wondered how long people actually wait to invest when they suddenly find extra cash? Let's break it down. Welcome. Every day, I break down personal finance questions asked on Stack Exchange, highlight the community's best answers, and sprinkle in some actionable takeaways. If you're into learning a little more about money each day, make sure to subscribe to the channel. Now let's dig into today's question. Today we're exploring a common question. Is there a standard time frame for dollar cost averaging surprise funds? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So in summary, someone just got an unexpected $10,000 and is thinking about the best way to invest it. They're deciding between putting it all in at once to take advantage of compounding or spreading it out for dollar cost averaging. They're also curious if there's a general guideline for pacing this kind of investment. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. According to one reply, deciding between dollar cost averaging and lump sum investing hinges on predicting market trends, which can be tricky. They suggest planning involves setting a goal, selecting an account type, and deciding on an investment strategy before worrying about timing. In the US, 401k accounts usually get steady payroll contributions, whereas IRAs often receive lump sums around tax. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. In one response, the discussion is about dollar cost averaging, which means buying more shares when prices drop to potentially lower the average cost per share. It suggests that choosing between lump sum investing and dollar cost averaging depends on a person's risk tolerance, financial situation, life stage, and priorities like having an emergency fund. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. In one response, it's noted that lump sum investing has historically outperformed cost averaging most of the time. However, for risk-averse investors, cost averaging over 3 months might be better. It advises investors to consider their risk comfort since past data doesn't predict future outcomes. All right, now that we've seen what the community had to say, here's our take on this question. Spreading investments over several months can balance risk and opportunity, especially in volatile markets. Some prefer to invest a lump sum right away to potentially maximize returns, particularly when markets are on the rise. Ultimately, it boils down to personal comfort with risk. For those cautious about market timing, dollar cost averaging can offer some peace of mind by smoothing out market ups and downs. So, in this video, we've covered how dollar cost averaging spreads investment risk over time, while lump sum investing could lead to higher returns in rising markets. Ultimately, personal comfort with risk plays a key role, even though historically, lump sum often outperforms. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.